Today we are going to unpack exactly how the 2026 US-Iran war is creating this really strange, divided reality in India's property market. It just seems totally disconnected, right? I mean, how on earth can naval movements in the Strait of Hormuz possibly change the price of a two-bedroom apartment? It's a fascinating chain reaction, really. A story of dominoes falling one by one, starting from global trade routes and ending right at your front door. So let's start where it all began, at the source of the fire. This conflict didn't just create political chaos. It immediately put one of the world's most critical economic choke points at risk. And you know, that leads directly to one thing: oil. And bam, here is the first major blow. With the Strait of Hormuz in jeopardy, crude oil prices shot past that dreaded $100 per barrel mark. Now, for a country like India, which imports over 85% of its oil, this single number isn't just a headline. It's a full-blown economic earthquake. It is the spark that lights the fuse for everything that follows. Okay, so that earthquake immediately sends aftershocks rippling across India. And we're not just talking about paying more for petrol. This price surge seeps into every single corner of the economy, but it hits one sector especially hard, the one built on steel, cement, and logistics, real estate. This lays out that chain reaction just perfectly. First, the oil price spikes. That makes transport, diesel, way more expensive. Then, the cost of crucial materials like steel and cement goes up, pushing overall construction costs up by a hefty 3 to 8%. All of this feeds into national inflation, which forces the Reserve Bank to keep interest rates high. And what does that mean for the average person? It means your home loan EMI stays stubbornly, frustratingly high, somewhere around that 8.5 to 9% mark. So what's the upshot of that whole domino effect? Well, here it is. Developers, particularly those in the mid-market segment, they get squeezed by these rising costs and they slow down new projects. At the same time, buyers, who are now facing higher loan payments and general economic jitters, get way more cautious. And this really hits the affordable and suburban markets, the parts of the system that are most sensitive to interest rates, the hardest. But, and this is absolutely the most important takeaway, the market isn't just slowing down across the board. No, it's fracturing. The exact same pressures that are crushing some segments are almost unbelievably boosting others. This has created what all the analysts are now calling a three-speed market.
So what in the world is a three-speed market? The best way to think about it is like a highway during peak rush hour. You've got some lanes that are just a total standstill, a parking lot. You've got other lanes that are kind of moving along steadily. And then you have a few express lanes where cars are actually speeding up. The same event, this global conflict, is creating completely different results depending on which lane of the market you're in.
This gives us a really clear snapshot of that division. So in the slow lane, you've got those luxury towers that rely on money from Gulf-based NRIs who are now, facing job uncertainty. You've also got the suburban projects in the affordable housing sector, which we know are super sensitive to high interest rates. But over in the fast lane, you've got warehousing, which is booming because of supply chain changes, and hard assets like land and rental apartments, which people see as safe havens to protect their money from inflation.
Let's break this down even more. The winners are clearly the established, more defensive assets. Think core city areas in Bengaluru or Kolkata. You're also seeing huge potential in Tier 2 cities, and of course logistics. But the vulnerable segments? Well, that's the speculative projects way out in the suburbs and, as we said, those high-end luxury towers in places like Mumbai and Gurugram that were so dependent on investment from the Gulf.
This quote from a market analyst just hits the nail on the head. It perfectly sums up one of the most complex things happening right now. For years, money from non-resident Indians in the Gulf was a huge engine for the market. But now it's become a double-edged sword. On one side, job cuts in the Gulf mean less money for fancy luxury apartments. But, and this is the other side, some of those same NRIs are actually returning to India, bringing their savings with them and buying up plots of land or family homes, especially in those Tier 2 cities.
So we have this big national picture of a market that's breaking into pieces. But to really see how this plays out on the ground, let's zoom in on one city that is telling a truly fascinating story of resilience: Kolkata. While the rest of the country is facing these major headwinds, Kolkata seems to be marching to the beat of its own drum.
I mean, just look at these numbers. It's wild. In the first quarter of 2026, when the national average for home sales fell by 8%, and a major city like Chennai saw a massive 18% drop, Kolkata sales actually grew by 5%. That is a 13-point swing above the national average. So what is going on here? Why is it bucking the trend so hard?
Well, a huge clue comes from following the smart money. Get this,
In 2025, right as these global tensions were starting to boil over, institutional investment in Kolkata's real estate just skyrocketed by an incredible 400%. To put that into perspective, that is 4 times the amount from the previous year. You had major players like Blackstone placing huge bets on the city. That's a massive signal of confidence in its fundamentals. But even inside this super resilient city, you can still see that 3-speed market at play. You have core areas with strong infrastructure like Rajarhat Newtown, where prices are climbing by 8%, mostly driven by strong local demand. But then you look at the outskirts, which are more sensitive to those construction costs and interest rates, and things are just holding stable, not really growing. So the story is never simple, it's always nuanced.
So really, Kolkata is performing this incredible balancing act. On one hand, yeah, it's facing the same problems as everyone else, higher costs, supply chain issues, but on the other hand, it's being lifted by these really powerful tailwinds. You've got super strong local buyer demand, a massive 60% jump in inquiries from Gulf NRIs looking for a safer place to park their money, and this absolutely booming logistics hub out at Dankuni.
All right, so let's bring it all home. What does all of this actually mean for you? Because whether you're looking to invest your money or buy a home for your family, understanding this 3-speed market is absolutely essential to making the right move in 2026. Okay, if you're an investor, what's the playbook here? This is definitely not the time for speculative bets. The smart play is to hunt for real value. You should be targeting ready-to-move properties from sellers who might be feeling the pressure. Focus on assets that actually generate rental income in those established city cores. And you have to keep an eye on those inflation hedges we talked about, plots of land near new infrastructure, and that booming logistics and warehousing sector. And what if you're a home buyer? Well, this kind of market actually creates some real opportunities. In those slower segments, there's a window, probably about 2 to 6 months, where you can find some pretty good discounts. So you need to negotiate hard. And please, most importantly, do your homework on the developer. You want someone who is financially solid enough to handle these rising costs. And my advice? Stick to established locations rather than taking a gamble on some speculative project way out on the fringes. And all this brings us to one final big thought. This whole situation really forces us to step back and ask what we even mean by a safe asset anymore. It shows us that in our deeply interconnected world, safety isn't just about a good location. It's about understanding these complex global currents that can ripple all the way into our own neighborhoods. In an era of global conflict, the very definition of a safe investment might be changing right before our eyes.